Hi, welcome to February's 4Thought, the shortest month of the year. But don't worry, we won't make this the shortest video, for better or worse.
Thanks for watching the last video. A lot of views there on the last.
Yeah, we had a big uptick in the views. I don't know if it was our outfit choices.
Must have done something right. It was nothing else going on.
Yeah, it worked so well, we changed it this time. So we're not wearing our comfy sweaters or anything. We have our business attire on
Early
today.
January was like a dead period there, and there was like a lot of people with a lot of time on their hands. So they said, maybe I'll click on this video.
Yeah, but Nathan's right. Thanks again. We always appreciate the time you give us. So this month we wrote a little bit about the world's least exciting topic, which is bonds. And I think maybe on purpose, maybe not on purpose that we did that, because I feel like it's an asset class that's maybe a little bit unloved, that you don't hear a lot about. So we sure hear a lot about the Mag 7. We hear a lot about AI, and bonds has kind of taken a back seat and kind of fallen off. So I thought it might be helpful. One, maybe Nathan could start a little bit just talking about, and we talk about it a lot because we haven't heard about it a lot in the last 2 years, where diversification is, why do we still use it? Why is it still important? And then maybe I, probably because I'm the older of the two of us, can talk more about fixed income.
Yeah, that's great. So, what Lauren was talking about, obviously what we've heard a lot about in the news and everywhere else is AI. AI is powering stocks higher, technology companies, growth stocks moving higher over the course of all of last year in 2024 and in 2023. So people want to participate in it. And we want clients to participate in that too. So you're in a portfolio, depending on your objective, because we work with clients who have mainly stock portfolios and no fixed income, all the way to clients that have a higher blend of fixed income and bonds and income need in their plan. So we work with a lot of different varying types of objectives, but you're going to participate in that growth. We want to make sure that it's warranted. So we put a plan together, and we're constructing a plan, and we're talking about what it is you want to accomplish over a period of time. And based on those things, we're saying, okay, well, this portfolio makes sense for you. The Mag 7 or the Magnificent Seven, the biggest companies, and you look at them in the S&P index, and it's a market cap weighted index. So what that means is, as their market cap grows, the bigger portion they represent in that index. So people will sometimes look at that and say, I don't want to be diverse. I want to just own these companies. These are doing the best. Or isn't the S&P diverse enough?
Correct.
And I think if you really understand how that index is constructed, you realize that it's not very diverse at all if you have those concentration periods like we're experiencing or have experienced in the last couple of years.
Yeah, like a lot of things, we all need an easy measuring stick. We need a barometer to see.
It's useful for that, right?
And it's very, very useful for that, but really not useful when it comes to someone's wants and needs and how we achieve.
I think looking at the S&P is great to say, hey, broadly the market's up.
Correct.
Or broadly the market's in a pullback. Okay, you can see those things. A lot of people look at the Dow Jones. It's a much more concentrated. That's a much smaller index of just 30 companies. So the S&P is broader in that regard, 500 companies.
That's right.
So they can say, hey, the market's up, market's down, but to what extent, and for what reasons and what companies are driving those things. So we want to make sure that we're communicating to you. We're not just buying just the index, and there's reasons for that.
Yeah, it's a tool in a toolbox. You want to have all the tools that you need for the job. So if we only used one tool, I don't think we'd be the best architects of your financial plan. So we want to use all those tools, and I think we could talk about this a lot. I'll just throw in my 2 cents so you guys know that I'm not AI generated, but what Nathan's saying, obviously very, very valid, very important. And what I always try to say about the S&P is people are most interested in its performance on the way up. We rarely hear people communicate, hey, the market was down 700 points today. Did I go down less? So I want to make sure that if we're measuring things, we want to measure them both ways to see why we do the things that we do. So that's enough of that. Now let's get into the juice. Let's talk about bonds.
Super exciting. I've been waiting for this part. I'm sure you'd fast forward into the point that maybe we'll put a little marker in the video so you can jump right to this.
Right, that's right. Or the opposite and skip over.
The reason that we haven't talked a lot about it, and you alluded to it, in the beginning of the video, in the last couple of years, they haven't really done anything positive to mention. Right?
Yeah.
So people are wondering, why do we still own them? Why do they have maybe, and this isn't for everyone that's watching this, but a lot of folks do have fixed income. Why do they still have it? Why should they have it?
Yeah. So let's talk first about, what are bonds supposed to do in our portfolio? So bonds are not there to generate growth. They're there to generate an income and provide some stability or ballast, as the fancy pants like to say, in the portfolio. So when the market's down, right, your portfolio may go down. In a normal time, whatever that is, or whenever it starts again, bonds would actually increase in value or at least maintain their value.
Yeah.
So then if you remember, we do a rebalance of the portfolio. Sometimes we do it on an annual basis, and sometimes we have a more concentrated need where the portfolio is out of whack, so we do it. So if you think about it, if stocks are down and our fixed income is up and we do a rebalance, that means we're buying stocks when they're down. And that's an ideal time to buy stocks is when they're on sale. So I think that's one important component of why bonds need to be in the portfolio. And like Nathan said, we have a curated client portfolio, like there's specific people that like working with us and vice versa. But within that grouping of people, we have some people that are still growing their assets to achieve their goals. We've had some people that may have achieved a lot of their goals and now need to generate an income to support that function going forward.
Right. And the folks that don't need to generate income, they have to stay diverse in a different way, right? So they're not just going to have all technology stocks or all growth stocks. They're going to have a diverse allocation of mainly still equity exposure, not a lot of fixed income, but you can still stay diverse in that. And then obviously the other side of that.
Yeah, exactly. These people need to keep pace with inflation, outpace it. So they may have an equity component of it. It may not be as big as someone that's in accumulation phase, but the person that's in distribution phase may have more fixed income in their portfolio. And again, do equities generate income? Yes. Is that income a stable, reliable, predictable? Probably not as much as you would get from a fixed income portfolio. So, you have to eat fruits and vegetables every day. You may not see that kind of increase your health immediately. And there's times where you don't want to do that. But if you have a balanced diet, that's an important component of it. So we want to make sure that we're communicating why we still think bonds are important. Now, we also want to make sure that on top of that, we say we've had 3 terrible years in the bond market that have been very abnormal. So I like to say this, even though Nathan brought up a good point. Just because I've been doing this over 20 years doesn't mean if you meet somebody that's done it one more year than me, I'm any smarter than them or vice versa. But I haven't seen a market like this in my tenure in the marketplace. And the one thing that I know over the time frame I've been doing this and over the observations I've made in the market is everything eventually reverts to the mean. So does that mean that bonds are going to be the best asset class of 2025? I don't know. Does it mean they're going to be the worst asset class of 2025? I also don't know that, but I'd have a stronger inclination to say that's probably less likely because we've had so many bad years of bond return. And even though the Fed has cut interest rates, and people like me that have just gotten a mortgage or people that have gotten a mortgage that's over 6% haven't been able to refinance yet, and we're asking ourselves why. Well, they aren't always correlated exactly like that. So there's more impetus in the market than just what the Fed does when it comes to long-term interest rates. So I think everybody knows that the mortgage rates are based off of the 10-year, and the 10-year interest, again, I know you can read it because we wrote it in the article, have actually increased almost as much as the Fed has cut short-term rates. So the yield curve used to be inverted. It is fortunate and unfortunately reverting back to the norm, just like I talked about. So in those types of environments, having bonds that are a little bit longer term, one, can increase your income, and two, have some limited potential to maybe increase in value or at least maintain more stability. So
you want to go into like the Fed, where you were mentioning how you were saying, hey, the Fed has reduced rates, rates really haven't come down, so they're pushing a lever, which is the lever that they can control on the short end of the curve.
That's right.
You're mentioning long bonds, right? So they're not exactly going to move in the same fashion. So people that are maybe expecting to, as you will probably want to do in the not too distant future,
That's
refinance, or we have a lot of you watching this who have purchased new homes in the last year, or
cars,
or rental property, or whatever, and you want to finance debt, refinance that. And when am I going to get an opportunity? I like to say just point out that, if rates come in a bit, but the predictions for these rates now, it looks like they're not going to go down as much maybe as we previously thought. There are reasons that you may not want rates to go down as much as you previously thought. Sometimes rates going down isn't a great thing. Sometimes rates moving down means, well, the economy is really slowed to a point where, okay, now we need to really make it more accommodative for growth. And we're gonna one of the ways we're gonna do that is we're gonna reduce rates greatly. So it's also, I was talking to a client the other day who was wanting to know when she was going to be able to refi. I was like, I don't know the answer to that. We don't know that, but you would take 10 times out of 10 your market performance, your portfolio performance being what it has been over the last couple of years, being very strong, historically speaking, and slightly higher rates over much reduced rates. And who knows, because there could be negative reasons, some not so great reasons for that if rates go down more than they're expected to go down this year.
Yeah, and I don't want to talk too much about bonds today, because again, like we've communicated, I hope that Nathan and I have a lot of value that we haven't unlocked for everyone. So we have a lot of knowledge and information and resources at the firm that we could get really in depth into these conversations and go based on your specific circumstance. So like we always say in every video, if there's questions or comments, feel free to contact us and we can have a one-on-one about how this pertains to you and your specific circumstance. But also, because I want to end this on a positive note like Nathan did, remember, the differential between rates isn't as great as it was. So yes, maybe you were getting a 3% mortgage rate 4 years ago, but what were you getting on your savings?
Mm-hmm. Right.
You were getting 0%.
Nothing.
So now you're paying 7% on a mortgage, but what are you getting on your savings account?
Yeah, cash yields are higher.
Maybe
The
4 or
returns are
5%.
higher. Fixed income bond yields are higher. So, you have to kind of look at it in totality of the situation, and things have been pretty good. So, while we don't know what rates are going to do
Correct.
in the near term, we know historically speaking what they've done after periods like this, and what bonds have done after periods like they've just experienced historically, is things have gotten better in the regards to total return for fixed income, and that's a good thing for long-term investors.
Yeah, and we always say long-term, and we kind of wrote in the article that investing it's a marathon, not a sprint. I'm going to throw something trite in there. That's my job in this conversation. But it really is true. If you have a short-term goal, that's different. And we're going to help you achieve that. But everyone is going to have a goal that's longer than a week or a month or a year. And use us for those as well. That's where we can add a lot of alpha and a lot of impact. It's helping you stay the course on that and then seeing over time what that has done. So, hey, I looked at my quarterly performance and I'm missing out on some potential. Remember, we're reflecting that based on what the plan dictates. Mm-hmm. So if your wants and needs have changed, then you come to us, explain that to us, and then we build that into the plan. And then we can change how the portfolio is invested. If we need to have a higher rate of return, yeah, we'll have to take on more risk. Yeah, we may have to take on more concentration. We have the ability to do it, but we're not going to do it just for doing its sake.
Right, because none of that is free, right? Every time you take on or shoot for returns, you're taking on more risk.
Yeah,
as Lauren just stated there. So.
And we could do a whole article, which we won't punish you with, just about a risk premium. So mm-hmm. what does that cost me to take out a longer term bond to get 5 or 6%? What does that cost me to concentrate my portfolio from a well-rounded, diversified portfolio to only owning a small handful of stocks? And again, I don't want to sound any older than I am, but I've been through this a lot of times. I remember people talking to me about Enron. I remember people talking to me about all different types of stocks that at the time seemed like the end all and be all.
Can't miss. They only go up.
It's a no-brainer.
Why don't I own more of those?
And unfortunately, seeing that some of those people that weren't able to take my advice have a negative impact to that. So nothing's worse than me, than I have knowledge that I can give that's beneficial for people, yet I don't have the ability to communicate it in the right way where they can absorb that advice. So we don't want that to happen. And speaking of communicating, we may have made this video a little bit too long. So we'll end the way that we started. Don't just give bonds a chance. Don't count them out yet.
Stay diverse. Don't give up on being diverse in a portfolio, even if you think in my long-term growth portfolio, it didn't have the same returns as maybe the index did. There's a reason for that. And then on the other end of the equation, if you have fixed income in your portfolio and it's been nothing but a drag, it's been no fun to talk about. Well, there's a reason that it's there. Yes, we can alter the percentages, and we have over the years, depending on the circumstances. And
We definitely have.
the bigger climate is there, kind of saying, hey, where does it make sense to draw income? Because stocks can produce income too, as you said. So, but don't give up on that either. And there's a reason to own those different type of things in your portfolio.
And I would just say one last thing. We hear a lot more people talking about performance than we have in the past 3 years. That's always a scary time because, then you kind of revisit the FOMO times where I got to take on a lot more risk, and maybe people in your circle, your friends and family, aren't thinking about those things. Maybe they don't have a sounding board like you do with me and Nathan. Again, we're open to have those conversations with those people. It doesn't mean they have to be a client. It doesn't mean we're going to charge them anything. We just want to make sure that people are getting balanced advice that's maybe unbiased. And if we can act as that for people in your lives, please feel free to take advantage of
Right.
us.
If they're important to you, they're important to us as well.
So thanks again. We look forward to talking to you again next month. Happy February.
Take care.